Stop, whatever you are doing right now, put it down. Because what is happening today, Monday, March 16, 2026, in the United States Treasury market, is a tectonic shift that the mainstream financial media is failing to connect for you. They are showing you individual tiles of a mosaic, but nobody is stepping back to show you the full, terrifying picture. When you see this full picture, it will permanently change the way you think about money, markets, and your own financial future. Stay with me for the next few minutes because this is the most important financial breakdown you will hear this month. It is a moment of truth for every investor. Before we dive into the heart of this crisis, if you haven't already, subscribe to this channel and hit the notification bell. In a world of financial noise, we provide the signal you need to protect your wealth. Share this video immediately with anyone you care about, because the Monday margin call is here, and most people are walking into it blind. Let us start with a single, devastating number, 4.28%. That is where the 10-year United States Treasury yield closed on Friday, March 13, 2026. On its own, it might not sound like a siren, but look at the velocity. Just 3 short weeks ago, this yield was trading comfortably below 4%. In just 21 trading days, we have seen a spike of more than 30 basis points. Analysts are calling this the steepest short-term rise in the 10-year yield since the volatility of 2021. Meanwhile, the 30-year Treasury yield, the long bond, is sitting at 4.90%, staring down the barrel of 5%. Even more alarming is the 2-year yield, which tracks where traders expect the Federal Reserve to set interest rates, hitting 3.75%. For the first time in roughly 3 years, the 2-year yield is trading significantly above the current federal funds rate of 3.64%. The bond market is screaming at the Federal Reserve. This is a margin call for the entire American financial system because $12.4 trillion in United States Treasuries have been identified as part of the 2026 refinancing and new issuance cycle. Every single dollar of that debt is being rolled over into a market where the real return, after inflation, is effectively zero. To understand the explosion, we have to look back at late February 2026. The U.S. Treasury conducted what traders now describe as a disastrous $16 billion 20-year bond auction. The government had to offer a much higher yield than expected just to convince anyone to buy their debt. This was the canary in the coal mine. Buyers were hesitant because the inflation data was turning toxic. The January Consumer Price Index stayed stubbornly high, and core PCE, the Fed's favorite metric, accelerated to 3.1%, smashing the consensus forecast. Then, the world changed. On the final day of February, coordinated military strikes by the US and Israel on Iran shattered the traditional financial playbook. Usually, a geopolitical crisis causes a flight to safety where investors buy bonds and yields fall. But this time, the catalyst was oil. Brent crude spiked past $113 a barrel, and WTI pushed toward $100. Oil isn't just a commodity, it is the lifeblood of inflation. When oil surges, everything becomes more expensive to make and move. Suddenly, the safe haven of treasuries wasn't safe anymore. Now, let's look at the sheer scale of the debt wall. The U.S. federal government has roughly $38 trillion in total outstanding debt. In 2025, about $9.2 trillion had to be refinanced, which was already an unprecedented burden. But in 2026, the pressure is intensifying. The average interest rate on total U.S. debt has surged from 1.6% in the zero-rate era to 3.36% and is climbing fast. Every quarter-point increase in that average rate adds approximately $95 billion per year to the federal interest bill. The math is becoming unsustainable, with a projected 2026 deficit exceeding $2 trillion. Fueled by a 27-day government shutdown and new military spending nut. Total issuance requirement for this year is approaching $13 trillion. This is happening as the FOMC meets tomorrow, March 17. Jerome Powell is walking into the most difficult meeting of his career. GDP growth for late 2025 was revised down to a measly 0.7%, meaning the economy is stalling, while inflation is heating up. This is the definition of stagflation, the nightmare scenario. This bond market chaos is hitting your wallet right now. The 30-year fixed mortgage rate is tied directly to the 10-year Treasury yield. When the 10-year was below 4% weeks ago, there was hope for 6.5% mortgages. Today, that hope is dead as rates push towards 7.5%. For an average home buyer, that is an extra $500 a month, or $6,000 a year. That is a car payment or a year of groceries. Credit card rates are stuck above 21%, and auto loans are refusing to budge. On the corporate side, bankruptcies are already 81% above historical averages. Companies that borrowed for nearly nothing in 2021 are now hitting a wall where they must refinance at punishingly high rates. This is a return of valuation gravity. Even the tech giants of the S&P 500, like Nvidia and Microsoft, are feeling the pressure of rising yields. When the risk-free rate of a Treasury bond goes up, the value of future earnings goes down. This is why the Nasdaq has crossed below its 200-day moving average for the first time since May 2025. The math is relentless, and it is working against every investor right now. Perhaps the most significant structural change is who is or isn't buying our debt. For decades, foreign central banks like China and Japan were the reliable backbone of the Treasury market. That subsidy is over. China's holdings have dropped by nearly $170 billion in 3 years. Where is that money going? It is going into gold. Central banks are buying gold at a pace not seen since the 1960s. For the first time since 1996, foreign central bank gold holdings have surpassed their holdings of U.S. Treasuries. They no longer trust the long-term purchasing power of the dollar. This creates a crowding out effect. If foreigners won't buy our debt, either American citizens must stop investing in stocks to buy bonds, the Fed must print more money, or interest rates must keep rising. Currently, we are seeing the third option, and it is painful. Net interest payments on the national debt are projected to exceed $1 trillion this year. We are now spending more on interest than on our entire national defense. More money is going to pay for the past than to protect the future. So, how do you navigate this reset? Smart money is moving into a defensive growth posture. This means moving away from high-debt tech companies and toward businesses with real cash flow and pricing power. Think energy, industrials, and commodity producers. In the bond world, institutional investors are fleeing long-duration bonds. Nobody wants to be locked into a 30-year bond at 4.9% if inflation stays at 3%. Instead, they are staying in short-term T-bills, rolling them over to stay flexible as rates move. And then there is gold, which has crossed $5,000 an ounce. While it pays no interest, it is acting as the ultimate insurance policy against a collapsing bond market. The Monday margin call is the end of an era of cheap money and easy growth. The FOMC decision on Wednesday and the upcoming retail sales and CPI reports will be the next major catalysts. If CPI comes in above 3% later this month, we could see the 10-year yield blast through 4.5% toward 5%, triggering a massive liquidation in growth stocks. This is the reality of March 2026. The conditions that made the last decade of investing work have evaporated. We are in a new regime of higher for longer, stagflationary pressure, and geopolitical instability. Those who recognize this reset will survive. Stay tuned to this channel as we track the Fed's every move and the unfolding data in the bond market. If this deep dive helped you connect the dots, make sure to like this video and share it with your financial advisor or your family. We are entering a period where information is the only true protection. Thank you for watching, and I will see you in the next update as we track the most important transition in modern financial history. Keep your eyes on the yields. They are telling you the truth. Would you like me to analyze the specific impact of the upcoming $1 trillion interest bill on federal social programs? Or should we look at which specific energy stocks are best positioned for this oil spike?